So our question for Chapter 6, if you were starting a business, what tax considerations might cause you to prefer to set it up as a proprietorship or a partnership rather than a corporation? And secondly, would you consider the average tax rate or the marginal tax rate to be more relevant when making that decision? So for proprietorships and partnerships, the things that would be beneficial would obviously be the cost involved. It's much less costly to start one of these two than it is a corporation, and the ease of it alone would be something you would want to consider when starting a business. And secondly is the tax portion of it. When you own a partnership or a proprietorship, you are not doubly taxed. You're taxed as if it's basically income. So there's much less involved there. There are other considerations. If the business has losses, the owner has losses, they're responsible for those losses as part of their personal finances. Same with the partnership. The partners share equally in all the losses that a business is going to have if there are losses in that area. My wife has a business. She is a proprietor of her business, and when we're putting together our taxes, we report all of her profits in her business as part of our income. And so there are benefits to that. When she has a fair amount of expenses that are part of her business, we're able to deduct those types of things on our taxes. So there can be benefits in that respect. And likewise, if she was to experience some sort of loss of her business, the loss of the business, or have other great expenses that would be involved with it, we would be responsible for those too. Not just the business part of it that would have to pay for it, but would have to pay for that out of our income as a whole, because we're together on our taxes and such. So there are definitely things to consider when you're looking at a proprietorship or a partnership. So when considering a corporation, when starting a business, there are advantages to it. It is versatile. The corporate structure is more versatile. It is a separate entity from its owner, from its stockholders. So there is going to be less risk involved for people that are involved in it. I guess they're not as vulnerable in terms of personal assets and things like that when it is a corporation. A corporation can raise capital much more easily than a proprietor or a partnership can. So there's going to be some flexibility there. Again, there's the issue of double taxation that has to be considered when looking at a corporation as well. So those are some of the things that would be considered when looking as a corporation in terms of starting a business. So on to average tax rate and marginal tax rate. The question is would you consider the average tax rate and the marginal tax rate to be more relevant when making this decision? My struggle with these two at first was that I was having a great difficulty in understanding the difference. I had it in my head that they were things that you would look at on a tax form and just simply check off a box on whether you wanted one to be used or the other when figuring out your taxes. And I can continue to look back at the textbook and other readings, and I was just really struggling with what the difference between them was. And I finally came across an article by a financial writer who kind of helped explain the differences in a way that I was finally understanding it. And basically what he said was if you're looking at an average tax rate, or he keeps referring to it as the effective tax rate, these can be used to measure a proprietor or a partnership's complete tax obligation. It is used to understand the part of their income that is just taken up by taxes as a whole. So you can use it when looking at, maybe one person's tax rate versus another person's tax rate, and you can come up with a number that's just, so you can use it as, for comparison, for instance. If you're looking at marginal tax rates, you can use it to measure how tax obligations will change. So you can use strategy to see how these changes will affect income and then affect the taxes that are involved with that. If someone is looking at maybe a deferral or an acceleration strategy, looking at marginal tax rates is going to help them make that decision. A business owner is considering buying a large amount of equipment for the business that will affect the amount of deductions that they're going to have. I would imagine that they can look at it for this year, and you already know the income for this year. Purchasing this large amount of equipment and having these deductions isn't really going to make a change in terms of your taxes because of where you're at with your tax bracket. It's not going to raise you up. Whereas next year you are projecting a much greater increase in income, and that's going to make the amount that you earn, that greater amount that you earn, into a higher tax bracket. By purchasing the equipment later, it may allow greater deductions, which could bring overall income, taxable income, down. So you can look at that. You can use that strategy using the marginal tax rate to help make decisions. So if you're a proprietorship or a partnership, you can use looking at these two methods as a way. So I could definitely see an advantage to looking at these two when making some of those decisions on what kind of business that you're going to set up. One of the things that he said was a better way of saying it is to measure the incremental tax consequences between the strategies. And while average tax rates measure the relative tax obligations of people, using a marginal tax rate can help you make financial planning decisions. And so that was what I finally came away from in terms of looking at these two and considering how you would use those in choosing to use to create a partnership or a proprietorship as a business.